Hello, everyone, and welcome back to another brand new episode of Tax Thursday. I am your host, DDQ, here with Smart Counsel's tax resident attorney, Dionne Kellier. Happy Tax Thursday, Dionne.
Happy Tax Thursday, Dee.
How's your week going? We had Thanksgiving.
My week is great. Thanksgiving was amazing. I ate myself into a food coma, which was amazing.
It's
How was yours?
The most wonderful time for you.
It is. I love this. November, December, January, favorite time of the year.
That's awesome. Yep, I had a great Thanksgiving. Just spent some time with my husband, and then we had our Thanksgiving dinner the weekend after. So kind of spread out, but it's also flu season, COVID season.
Yes.
And then RSV, everything just going on. So it's just better to stay away from people.
Totally agree.
Thank you all for joining us again for another episode. For those who are new here, Smart Counsel is a minority and woman-owned firm handling all kinds of practice areas such as energy, corporate, regulatory, and tax. So visit our website at www.smart-counsel.com to learn more. This week's topic, we will be discussing the Farmer's Tax Guide, what it means, and who does it truly apply to, and more. So, Dionne, to get things started, who or what does the IRS consider a farmer for this Farmer's Tax Guide?
Perfect. All right. So you are in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. And a farm includes livestock, dairy, poultry, fish, fruit, and truck farms. It also includes plantations, ranches, ranges, and orchards and groves. And a farmer, like other taxpayers, must keep records to prepare an accurate income tax return to determine the correct amount of tax. And publication 225, so IRS publication 225 is what controls how farmers are taxed. So if you ever want to reference anything that I'm discussing, it's IRS publication 225.
225.
Yeah.
Awesome. Okay.
So
I'm assuming you're going to go into what qualifies a farm.
I will go into that. Let's see. Let's first talk about the record. So basically in order for any business to be considered a business, you have to have a profit motive, right? So if it doesn't have a profit motive, then it's not going to be considered a business. So if you just, go to somebody's farm and volunteer, and you in yourself will not be in the business of farming. Actually, a better example would be like if in your backyard, right, you are, growing tomatoes and growing pineapples and growing something else, I don't know, for your own pleasure and to feed your own family, you would not be somebody that's considered to be in the business of farming.
So that would be more of like a hobby farm is what I kept reading.
Exactly. It's just for fun, and you will not get the benefits of, people that's in the farming business. So let's see. So the first thing, the most important thing that I found in doing this research is it's almost like the marijuana industry. And you should keep permanent records, because at the end of the day, the IRS only has to make the allegation that that your tax payment is insufficient. It's called notice of deficiency. So that your tax payment is insufficient, and it's up to you to prove that the IRS is wrong. So it's up to you to prove that, deductions that you took, they were proper, the assets that you own, that that the basis, which is what you paid for it, is exactly what you said that it is. And the IRS is not going to do the digging for you. And if you do not have something to substantiate the numbers, then it's going to be to your disadvantage, right? So let's talk about the record keeping, and then we'll get into the specifics. And there's so much information on farming, so let's see, we may continue it on our next Tax Thursday, or we may not, because let's see. All right.
Okay. So before we do go into that, though, does a farm have to make a certain amount of money to be considered a business?
No, it doesn't have to make a certain amount of money, but if you make under a certain amount of money, then there are some, because there are two accounting methods. There are more than two accounting methods, but there are basically, they either use a cash method for accounting or an accrual method for accounting. And typically farmers had to use the accrual method, but with tax reform and some changes, I think in 2022, if your farm makes under $27 million, you are allowed to use the cash method as opposed to the accrual method. And the only, like, I guess the cut and dry difference is with the cash method, when you receive the cash, or when all of the hindrances to you receiving the cash have been removed, then that income is considered to be received. Whereas with the accrual method, it's when you actually complete the job and receive the fund. Well, you get, so with the accrual method, if you complete the job today and you should have been paid today, but you don't get the money until 2023, you have to include it in your income. Whereas with the cash method, if I completed the job today, I'm supposed to get the money today. So that's why it'll be included currently. Whereas accrual, you may have, a timing situation where you don't necessarily have to include the money today.
Interesting. Very interesting. Okay. Cool. Perfect. Yeah. Let's go into record keeping, how
All right.
important that is and what we should keep.
So the benefits of record keeping in your business is you're going to monitor the progress of your farming business. It's going to help you prepare your financial statements. You're going to identify the source of receipts. So wherever you spent money or made money, you keep track of your deductible expenses, you prepare your tax returns, and you support items reported on your tax returns, which is, as I said, the IRS only has to make the allegation. What in these times, or before, most people kept paper. Now I would suggest keeping electronic records. And I remember they had that machine. I can't remember the name of it, but it was like that white machine, and you put your receipts in there and it kind of categorizes everything. I actually have not seen it advertised in like a year or two, but because I used to read reviews on it that said it was not that good. So I mean, just old school, scan it, save it to your hard drive or save it to a thumb drive. I love a spreadsheet. So I would, not only would I scan it, but I would also log it into my spreadsheet to be like, expenses for 2021 crops here, receipt of income from 2021 crops here. That's what I would personally do.
And there is a scanner on your iPhone in the notes
Is
app.
there? So I just updated my phone this morning. Actually, both phones this morning to the new iOS, and it did change it. It's a little weird, right? I hate updating my phone.
I know. You do with no choice at some point where you have to update.
How do I change the font? And why are my notifications stacking? That's what I'm at. That's where I am right now.
No.
I know. So if you change, I just changed it this morning. I should have probably changed it last night so I could have figured my way through it, but it's okay. I'll figure it out. I'm officially turning into my mom.
Dude, I know. I'm the same way though. Like I have tried to push off updates as much as I can because it always just is like a whole new learning curve with everything.
It told me even because this is 16. I know that because it said that I skipped 15, right? Because like, why did I? Yeah, I just ignore. But I hate seeing those little notifications, those red notifications. Make me crazy.
Same.
All right, I digress. All right, so the kinds of records to keep. So travel, transportation, entertainment, and gift expenses, employment taxes, and of course, copies of your tax returns. So for assets, what are assets? They're properties such as machinery and equipment you own and use in your business, and you must keep records to verify certain information about your business assets. You need the records to figure out your annual depreciation deduction and the gain or loss when you sell the assets. So the records that you're going to keep is going to show when and how you acquired the asset and whether it was new or used, the full purchase cost of the asset, cost of any improvement, if you took any Section 179 deductions, if you took any depreciation deductions, if you took any deductions for casualty losses such as losses from fires or storms, and of course, Florida, during hurricane season, our farms, they go through it. And funny enough, during our winter freeze, which may be like a day or two, it ruins a lot of crops, right? So like when we get below, I want to say 60 or even getting close to 60. I know other places would laugh at us, but they're like, bring the plants inside, cover, plants, bring your pets inside. Because these things, especially like our citrus, they get that freeze on them and then they're not worth anything.
Yeah.
Let's see how you use the asset. When how you dispose of the asset, the fair market value of the property when traded, the selling price, the expenses of the sales. And the following examples that may show this information are purchase and sales invoices, real estate closing statements, canceled checks, and bank statements. So one thing that I wanted to say with the fair market value of the property when traded, and this is just an overall business thing. If you are selling something, right, you have to sell it at fair market value or have a reasonable explanation for why. And especially if you're selling it to somebody that you're related to or a business that you're related to. Because basically, if you give somebody a sweetheart deal and you pay and you sell something for less than what it would sell for in the market, in the open market, and then you try to claim a loss, the IRS is going to deny that, right? Because you gave somebody a sweetheart deal for the benefit of capturing a loss, and that's not how it's supposed to work. How, maybe if you did improvements to it, if you did improvements to whatever the property was, it would up your basis, which would then change what your profit margin would be. And what I mean by that is, like, say you bought something for $100, right? And then you sold it for $250, right? So at that simple example, you made $150 profit. The things that changed the basis, maybe you did some improvements to it that cost, $10 here, $5 here, $15 there, that now equal $200, right? So it's $100 you paid for it, and then the improvements that you did to it brought it up another $100. So now your basis is $200, and you sold it for $250. Your profit would be $50 as opposed to $150 because you spent more money to get it to the place that it's at in order to sell it. And that's just a little rough for any business, even if you're selling a house. So like now with your house, like for instance, right, any improvement that you're doing to your house, keep track of it and make sure you guys keep receipts, right? So that you are able to, when you go to sell the house, outside of the exclusion that the IRS gives you, your basis is going to change. If you did any, you put new flooring in, if you change the roof, if you, I don't know, whatever you did, it's going to take it from what you paid for it. You're going to add all these improvements to it. And then whatever you sold it for, that is going to be your profit, as opposed to what you bought it for and then what you sold it for that to all be profit.
That makes sense.
FYI.
Interesting.
All right, so let's see. Financial accounts that have financial account statements as proof of payments. If you have your credit card statement, if you did an electronic funds transfer, or you did a check, I would say do things in check form so that you can keep a copy of it. And this is for any business, right? Farming, if you're selling your personal house, if you if you have inventory and you sell things. I like to keep electronic records of everything just because you never know.
Yeah, for sure.
Let's see. Employment tax records. You have to keep their records for at least 4 years after the date that the taxes are paid or become due. The assets we talked about, and records for non-tax purposes. I would keep everything, like they say 3 years, right? But I would keep everything for a minimum of 5 to 7 years.
Really?
Even though I'm a shredder, but I know I shred everything. I've even tried to pull something out of the shredder because I was shredding.
Oh no!
Oh yeah, no, I am that person. Yes, you should keep these records, right? So for business wise, I keep my records. I am very good with other people's money. That's the one thing.
That's good.
All right. So, now keeping these records, now we're going to talk about the accounting methods that are going to be utilized by farmers. And these accounting methods are used by every business, but we're going to talk about why it's important to the farmers. So an accounting method is a set of rules used to determine when and how your income and expenses are reported on your tax return. Your accounting method includes not only your overall method of accounting, but also the accounting treatment used for any material item. Facts and circumstances affect whether an item is material. Factors to consider in determining the materiality of an item includes the size of the item and the treatment of the item on your financial statement. Generally, an item is considered material for financial statement purposes, is also considered material for income tax purposes. And you can choose an accounting method for your farm business when you file your first income tax return. That includes Schedule F, because Schedule F is for farming businesses. So the types of accounting methods are cash method, accrual method. Those are the two most common. Then there's special methods of accounting for certain items of income and expenses, and then there's a combination of both. So for business and other items, you can account for business and personal items using different accounting methods. And so if you have two or more businesses, two or more separate and distinct entities, which would be yourself, distinct from your business, you can use, a cash method for yourself and then an accrual method for your business, or a combination of either. So the cash method. Most farmers use the cash method because they find it easier to keep records using the cash method. Certain farm corporations and partnerships and all tax shelters are generally required to use the accrual method of accounting. However, for tax years beginning in 2022, farm corporations or partnerships that have an average annual gross receipt of $27 million or less for the preceding 3 tax years and are not tax shelters can use the cash method of accounting instead of the accrual method. So I guess that's what I was trying to explain earlier. So everybody can use the cash method if you're under $27 million or less for the last 3 preceding years. So under the cash method, you include in your gross income all items of income you actually or constructively received during the tax year. And items include money received as well as property or services received. And if you receive property or services, you must include the fair market value of the property or services that you received in your income. So no sweetheart deals. Has to be what the market would bear, arm's length transaction, fair market value. They all mean the same thing. Mm-hmm. What 2 random people would pay in the open market.
Right.
So,
and that's for the accrual, right?
Well, that's for any method. That's for anything. Okay. So we're talking about the cash method now, but fair market value and the arm's length transaction and the no sweetheart deals is basically if you're including anything in your income and you made say that I'm selling it to my sister. Mm-hmm. If I gave her one price and I gave you another price, the IRS is going to use your price, and then they're going to say that I basically gifted her the other amount, and then let's see, does it fit into the gift tax rules?
Right. Yes. I was just going to ask that. Okay.
Yeah. So, and gift tax rules, it went up to $16,000 for 2022. So each person can gift up to $16,000 for as many people as they want, but if you're married, $32,000. If you are single, $16,000. So as many people as you want, and it'll just lessen your taxable estate when they're calculating it for your date of death. I know that's all over the place, but we got to talk about everything, right? Because it all
like meshes together somehow.
Exactly. So, constructive receipt. Income is constructively received when an amount is credited to your account or made available to you without restriction. And you do not need to have possession of the income for it to be treated as income for the tax year. You just need to have the ability to receive the income. And if you authorize someone to be your agent and receive the income for you, you're considered to have received the income when your agent receives it. You cannot hold checks or postpone taking possession of similar property for one tax year to avoid paying tax on the income in that year. You have to report it in the current year. So an example, a farmer using the cash method of accounting was entitled to receive $10,000 payment on a grain contract in December 2022. He was told in December that the payment was available and requested to not be paid until January 2023. He has to include that $10,000 payment in his 2022, even though he's going to receive it in 2023 because there were no restrictions to him receiving it. He just wanted to, play around with the timing. And this happens very frequently. And if the IRS puts it into writing, that means that it happens like a billion times. And so anybody who thinks that they are going to, that they've thought through it all, the IRS has seen it all. They've thought through it all, and nothing is new under the sun to them.
Right, exactly. Okay, that makes sense.
Yep. All right. So if your debts are paid by another person or canceled by your creditors, then you can have income. You can have the debt that was relieved. It's going to be considered income. If you sell an item under a deferred payment contract that calls for payment in a future year, there's no constructive receipt in the sale that year. And so you don't have to include it in your income. You just have to include it when you receive the money. And if you include an amount of income and in a later year you have to repay all or part of it, then you can deduct that from your income because the IRS is fair.
In IRS terms, they're
Yeah,
fair.
exactly. It's fair, right? If you accounted for something as income and then you had to return it in a later year, then you're able to deduct it, just corresponding.
Mm-hmm.
Under the cash method, you generally deduct expenses in the year that you pay them, and this includes business expenses for which you can test liability. However, you may not be able to deduct an expense paid in advance or that you may be required to capitalize. If you do prepayments, you cannot deduct expenses paid in advance. You can only deduct it in the year that it's due. So, people are super creative with the things that they do and how they try to avoid paying income, tax on income that they received. And so, as I said, there's nothing new under the sun. So
Right.
that's the cash method for farmers. Under the accrual method, you generally report income in the year earned and deduct or capitalize expenses in the year incurred. And the purpose of the accrual method of accounting is to correctly match income and expenses in the correct tax year. Certain large farm businesses must use the accrual method of accounting for its farm activities and for sales and purchases of inventory items. So for their income, you have to include an amount in the income for the year in which all events that fix your right to receive the income have occurred, even though you may not receive it until like the following year. But as long as all the restrictions to receiving it have been removed, then it's going to be includable in your year. Let's see. If for inventory, generally, if you keep inventory, you must use the accrual method of accounting to determine your gross income. And in inventory is necessary to clearly show income when the production, purchase, or the sale of merchandise is an income producing factor. But the exception is if you, for tax years 2022, if you have under $27 million for the past 3 preceding years, you are able to switch to the cash method. Let's see.
And is that under 27 million
Yeah.
total for the 3 years?
No,
Or
27 million each year. So for tax years beginning in 2022, you're not required to maintain an inventory if the average annual gross receipts for the 3 preceding tax years for the farm is 27 million or less and the farm is not a tax shelter. In this case, the farm can use the method of accounting that treats the inventory as non-incidental materials and supplies, or accounts for the inventory in the same manner as the applicable financial statements, conform to its treatment of inventory in an applicable financial statement. If it does not have an applicable financial statement, it can use a method of accounting used in its books and records prepared according to its accounting procedures. So basically, they can use the cash method of accounting, right? So that's the accrual method is beneficial. I feel like the accrual method is beneficial to people that do have inventory, right? Because if you have $10 million worth of inventory, that's not your money because you're just going to get the profit or you're going to get the net of whatever you receive. Because if you have something that you sell for $1 million, then you paid $500,000 for it. You didn't make $1 million, you made $500,000. So that's where, to me, it makes sense. Whereas if you sell a service that's $500,000 and you did the service and now you're supposed to get paid, you're making $500,000, not, you know what I mean, as opposed to that other example. So that's my opinion. So under the accrual method of accounting, you generally deduct or capitalize a business expense when both of the following apply. The all events test has been met, and it is met when all events have occurred that fix the fact that you have a liability and the amount of liability can be determined with reasonable accuracy and economic performance has occurred, which basically means you get paid for whatever it is you said you were going to do.
Makes sense.
Right? So let me give an example. So Jane, who is a farmer, uses a calendar tax year and accrual method of accounting. So to take advantage of early payment discounts, she paid for a seed in October 2021. The seed was delivered to her in March of 2022. Economic performance did not occur until the seed was delivered and planted. So Jane incurs the expense that she paid in 2021 in 2022. And there's an exception to the economic performance rule, and it allows certain recurring items to be treated as incurred during a tax year, even though the economic performance has not occurred. And, there are examples for that, but I feel like if you're a farmer, we could get more into the weeds of that. So I
Right.
won't even get into
Literally.
those examples.
Okay.
Let's see. Accrual method. Generally, the following business and engaged in farming are required to use the accrual method. Corporation that has gross receipts of more than 27 million. A partnership with a corporation as a partner if the corporation makes more than 27 million, or a tax shelter. What is a tax shelter? It is a partnership, non-corporate enterprise, or S corporation that meets either the following tests. Its principal purpose is the avoidance or evasion of federal income tax. It's a farming syndicate, and a farming syndicate is an entity that meets either the following test. Its interests in the activity have been offered for sale in an offering required to be registered with a federal or state agency with the authority to regulate the offering of securities for sale, or more than 35% of the losses during a tax year are allocable to limited partners or limited entrepreneurs. A limited partner is one whose personal liability for the partnership debts is limited to the money or other property that they contributed or is required to contribute to the partnership. And a limited entrepreneur is one who has an interest in the enterprise other than a limited partner and does not actively participate in the management of the enterprise. An active participation, I know for real estate, is 720 hours for the year. So I'm presuming it's going to be the same for active participation overall. Any questions so far? Am I just moving?
No. Yeah. I mean, the only questions I really have is just like, what exactly can farmers write off? Is there any write-offs for them, or
Absolutely. So, let's see.
I know it's
They,
kind of like jumping.
yeah, no, it's fine. Let's see. For their income. So, they are. I don't know. Oh, let me see that. So they are okay. So farmers are basically, they're any other small business, so they're able to write off their expenses like their rent, their water, their if they have losses caused by like casualties like hurricanes or earthquakes or things like that, weather related conditions. If they have to, like, say that there was a drought or something that happened in another part of the country that is going to affect their business, they're able to write off, like say that they have to sell like all of their cows today because of a drought say that somebody in Colorado has to sell all their cows today because there's a drought in Florida that's going to affect them. That's going to affect Colorado in like months, so they can like forecast and see this. They do not have to include all of the inventory that they receive. They can show the history of, okay, in each year we would have sold 20 cows, but because we had this incident, this weather related incident, we had to sell 60 cows. And so the IRS is reasonable and will allow them to do it over 3 years. But as far as like their business expenses, any other expense that any other business is allowed to deduct, a farmer is allowed to deduct that. And they also get a lot of grants, given to them. And they are the business that hires the contractors or that hires the employees. They even, I could say that they could probably even take advantage of the R&D credit, depending on if they, created some innovative way to, process. We'll go into kind of like our industry, right? So process hemp or anything that's under 0.3% THC. If they've developed a process that makes it easier, they are in the industry of farming. Yes, they don't have animals or anything, but they have, they have product. And industrial hemp is considered something that's under the Department of Agriculture, and it is just like any other business. So like say that they buy the seed for, $5, and then that seed nets $5,000. Well, then they're paying tax on 5,000 minus $5, right? And but then you have to, so they would pay tax on 5,000 minus 5, but then you have to include all the expenses it took to get to the product. So the irrigation and all of the, and for that anybody that touches the situation, as far as a supervisor, people that are planting,
Mhm.
if they lose anything, the water, they could deduct anything. I in farming and even in the marijuana industry, I am of the opinion that producers have the biggest amount of deductible expenses, and the biggest amount of things that are included in their cost of goods sold, because it's everything it takes to get the product.
Right, right. That was going to be one of my questions too. Like, would hemp farmers fall under this farmer's tax guide?
Absolutely. Hemp farmers, and to a certain extent, marijuana farmers, right?
Mm-hmm.
Because the marijuana farmers, they just have to keep better records they're going to be more scrutinized than a hemp
Right,
farmer,
right.
because, the IRS is definitely not trying to include everything in their cost of goods.
Yeah.
So, they just have to keep really good records. So you have to know that this supervisor is required to be here, because if this person is not here, then we would not get the end product. Whereas with hemp, you don't necessarily have to show that. It's just somebody that works there, right? It's just like selling roses and selling, Tootsie Rolls.
No, that makes sense. So a lot of what we discussed today was like on the federal level. Does it change at any point when it comes to the state level? with
Different
taxes?
states give different advantages, and I saw one of your questions. Montana has the most favorable tax laws for farmers, and so
Interesting.
that's somewhere that, and it makes sense, right? Because it's pretty open there,
Yeah.
and so I would think that. So actually, it's Montana, and then I actually pulled it up. Montana, and then Kansas, then North Dakota, then Texas, Oklahoma, South Dakota. Colorado's number 9.
Okay.
Yeah, I would think. Where's Florida? Florida's number 34. Interesting. Alaska's number 50, which I actually would have thought that Alaska would have been higher on the list, just
Yeah.
because they have so much open land, but maybe their laws are not favorable. So maybe the last tax Thursday that we do for the year, I'm gonna discuss Alaska and like why. Maybe
Yeah.
Alaska and Hawaii. We'll see.
Oh,
Like,
that'd be interesting.
right? Like, because I'm kind of interested to know now. So I think
Right.
that's what I'll do, just to see like what makes it, why Alaska would be number 50 and Hawaii is number 40, when I feel like these are
Very
places that
interesting.
are not as inhabited as the other places. So I would figure that
Right.
farmers, even though Alaska, yeah, it's cold, but there's people that do things in the cold. So I don't see that as being a problem. Maybe
Right.
they have, maybe their winter stuff far surpasses what farming would do, so that's why they don't even care. We'll find out. I'll find
Mhm.
out.
No, that's a
So
very interesting topic. But so Montana is the number one tax friendly state for
for
farmers.
yep.
Interesting. I wonder what like is one of the most popular farming agriculture products out there.
In Montana, let's see.
Yeah.
Let's
Like I've
see.
never been. I've always wanted to go though.
I don't know.
If you're trying to avoid Colorado, I'm sure you'll probably want to
You
avoid
already know
Montana.
that. To me, Montana is cold. I want to see why they say Montana. It's like it has the lowest average per acre cost of farmland. It's the top supplier of beef, and it leads the nation's production of organic certified wheat, lentils, flax, dry peas, and honey.
Nice.
Interesting.
That is interesting.
That is very, very interesting. Yes, I like that. See, I like learning stuff. I feel like things like that are so interesting.
No, definitely. I think so too. I think that's super interesting. That's
Yeah.
awesome. Okay. Well, I guess to kind of wrap up, our episode today, what would be our main takeaways from the farmer's tax guide topic?
Okay, so as a farmer, keep permanent records, because all the IRS has to do is make the allegation. You have to defend, you have to back your way out of it. if you are a farm, whether no matter if you're in the farming industry and over the preceding last 3 years you've made $27 million or less, you are able to use the cash method of accounting. And there are cash and accrual methods of accounting. Cash methods are simpler, and they're simpler. And if you have the ability to take advantage of using the cash method of accounting, then you should do it. And for everything that you do, there needs to be a basis for it and a backup. So I say that to say, if you have something on your financial records, right? Because everybody keeps different sets of books. So if you have something on your financial records that is not supported by documentation, then it should not be on your financial records.
Okay. Always have some kind of paper trail,
Always.
receipts of some kind.
Exactly.
Okay, perfect. Well, I hope, we obviously were just talking about, we learned so much from this topic. I hope you guys who tuned in learned a lot. If you do have any questions, please shoot them in the comments down below or DM us on Instagram, or you can directly email us at attorney@smart-counsel.com. We can always just, like you said, dive deeper into the weeds with these kind of topics, but try to keep it very basic, very simple for you guys. Try to, I guess, translate what the IRS is telling you as a possible farmer or a taxpayer in any kind of situation. But thank you, Dionne, again for your knowledge and your expertise on this. It was very interesting to learn more about the Farmer's Tax Guide.
Thank you so much. I appreciate it.
Awesome. And thank you guys again for joining us for another episode of Tax Thursday. Make sure you're following us on all of our social media platforms. We're on Instagram, Facebook. Visit our website. Make sure you like this video, comment down below, and subscribe to our YouTube channel so you do not miss a future Tax Thursday episode. Until then, we'll see you guys next time.
All right. Have a wonderful. All right.
You too.